Monday to Friday at 12:30 p.m. only on BloombergQuint.
Good morning and welcome to BloombergQuint, India's first digital live streaming business news service. I'm Neeraj Chan, you're watching Indian Open. Let's go straight to the headlines. Boris Johnson looks set to win a full majority for the Conservative Party in the United Kingdom elections. Donald Trump has signed off on the Phase 1 trade deal with China, halting the imposition of higher tariffs which were set to kick in from December 15th. The European Central Bank chooses to stay put on rates in Christine Lagarde's first policy meet as president. The Citizenship Amendment Bill is now an act after the president gave his consent, even as 2 people are now dead in police firings in Guwahati. And world markets are actually, celebrating all that's happening in the last 12-odd hours on the global front. So, it's good news, you would have to say. I think post Donald Trump tweeting out 5 minutes after the US equity markets opened that they are all set for the deal, sent the US markets high. And the world index, this is what the US markets did. So it's a great green on the screen, and you can't complain with a screen like this. Remember, for the last few days we've been talking about how there were chart study done on Bloomberg which said that the S&P 500 has a fighting chance of hitting the 3,200 mark, But look at this. There's a global stock index which has climbed above the January 2018 peak for the first time ever. This is a global stock index, by the way, an index composing of a clutch of other global indices, weighted averages put together, and that index has hit highs and eclipsed the January 2018 highs. Remember, 2018 and 2019 are marked years wherein after hitting the peak, the markets have come off. Now we are having that bit of a risk-on rally starting off. And why not, I would say, because just look at the quantum of risks that seemingly are off the table now. One, we have got the phase 1 of the deal agreement signed. There is a likely conservative majority in the UK, which would mean essentially, what does this mean? This means that the hung house is no longer a question mark in the UK. Then Democrats and Republicans have averted a US government shutdown as well. And hey, Fed is adding nearly $500 billion in year-end liquidity, and liquidity drives markets higher. So a lot of risks are off the table right now from a bull's perspective, and that should only augur well. The caveat, though, is that whether this will be followed with volatility. And just one quick reference, again, on the global front to what's happened in the past and what could happen ahead as well. When the S&P 500 and VIX have risen together, and we've been talking about how in our markets as well, we're seeing the VIX rise on the day the markets rise and VIX fall on the day when the markets fall. But in the past, when this has happened, it's led to bouts of extreme volatility. Will we see that? That's the only key question. But having said that, nobody's complaining. The world markets aren't complaining right now. There is not too much of merit in trying to figure out what individual nuances of each market is. But just look at the Asian screen. A sea of green and very strong green there. The SGX Nifty a lot more tempered right now. Remember, we had a bit of a rally in trade yesterday, you would have to admit. I don't know if the Indian markets and traders out there preempted this, because the nature of the move yesterday, the kind of stocks that went up yesterday all hinted towards this. Now we have that. Let's see if Indian markets do a follow-up and make a dash towards 12,100, or do we stay a bit subdued compared to the rest of the world markets? That's the only question. But look at this. We had a bit of a rally in our markets in trade yesterday. However, like I said, I don't want to kind of spend time on what the internal nuances are and what RSI indicators are, etc., because today it's more a global driven rally, and that's what will happen. But there are specific stocks that you should watch out for naturally. So on the downside, I would reckon you should watch out for TCS. I do not know if it's correct or no, but they have confirmed, Shapoorji Pallonji, to various forms of media, that they have sold shares in TCS yesterday. There was a large block which was still open for sale post market hours closing yesterday, and let's see if that puts in some more pressure on TCS stock in the session today. We'll wait and watch. Dr. Reddy's in all likelihood could have a start which is in the red, because there's a competitor, Amneal, which has launched the generic version of Nuvaring in the US markets, which is about $976 million gross sale market. Most brokerages have come out and said that this is a negative. Darshan will talk about this a bit later on. But Citi said that there are negative implications for Dr. Reddy's, the approval of which has been delayed potentially to second half. And Morgan Stanley said that Amneal's launch implies weaker economics for Dr. Reddy's as and when it does launch. So thing you got to keep in mind. The trade deal signed should augur well for some of the globally exposed stocks. I would watch out for Tata Motors, Madan Suzumi and the likes. Very active in trade yesterday. Let's just see if there's some more traction here. And lastly, Simplex Infra. Care Ratings has revised its ratings for the bank facilities to default rating. Not just this stock individually, but a lot of AMCs who hold the paper could also be in focus today. So do watch out for Simplex Infra. Multiple impact and not just for the stock individually. However, let's tell you what's lined up on First Word today. We have to start off with the latest on the UK elections as Sebastian Salek of Bloomberg joins us from London, and we speak to Jeffrey Dennis to understand how markets will treat Boris Johnson's almost certain victory. Jody Schneider sums up why Donald Trump's chosen to avert imposing higher tariffs on Chinese imports, for now at least. Back home, the macro data isn't looking any better. Pallavi takes us through the latest reading of industrial production and consumer price inflation. Sajid talks about why India's wealthy chose to pull out from short-term alternate investment funds. And lastly, Agam comes in to talk about why Tata Global Brokerage or Tata Global Beverages has, as a stock, has a spring in its step right now. Okay, I think you got to focus on what will happen to the world and what's happening in the world. And there are, as I said, because of the risk of element that probably the world market sees in itself right now, you probably have positive news for across geographies. And I think it'll be important to put this into perspective as to what happens. So we'll get an editorial perspective as well, and we'll get a market perspective too as to what would this mean for world markets. Both, to my mind, the bigger news, of course, is the phase one of the trade deal. But since it's looked like Boris Johnson's gamble for an early election has paid off, it is something that we should try and talk about this as well, because after months of flips and flops, so let's start off with the first news. After months of flips and flops and negotiations, Donald Trump has signed off on phase one of the trade deal between the US and China. This comes just ahead, remember, of the December 15 deadline when US was set to impose fresh tariffs on Chinese goods. Jody Schneider of Bloomberg News First has this report.
Well, people familiar with this have told us that President Trump has signed off on this phase one deal that we've been talking about, that he's been saying is close since October. This basically, what we're being told, this would avert those December 15th tariffs on another $160 billion in Chinese goods. Those would not take effect. That China would be buying more agricultural goods from the U.S. and would be making some commitments on intellectual property rights, and the U.S. would look at rolling back some of those previous tariffs. We have not yet heard from China on this. There is a 9 o'clock event where the Chinese foreign minister will be. It's not a trade event, but it would be an opportunity to say something about this deal. President Trump tweeted yesterday that there would be a very big deal being announced. Of course, we don't expect a big deal. This phase one deal was always supposed to be about ending the next round of tariffs and trying to get some of those commitments on more purchases from China of agricultural goods.
Of course. So that's as far as the trade deal goes. Now let's get a perspective on Boris Johnson's gamble on the early election, which seems to have paid off because he looks to be on course for a decisive victory, putting the UK back on track to leave the European Union next month. Bloomberg Sebastian Salek joins us right now from studios in London with the latest. And Sebastian, you would have spoken to a bunch of people now post these exit polls coming out. What are people making of this?
Well, people seem to be pretty surprised by what we're seeing. The exit poll was a bigger majority for the Conservatives than what anybody had really expected. And as we've seen those results drip through, it seems largely to be coming true. It's just gone 2:30 in the morning here, so the exit poll is about 4.5 hours old. What we're seeing is a very strong correlation between votes for the Conservatives and votes for Brexit back in 2016. So it seems that this has been the key issue for people. Boris Johnson trying to make this Brexit election has paid off, and as a result we're seeing a lot of seats changing hands, particularly the Conservatives picking up Labour seats that perhaps they've never held before. As a result, it's set to be a very dire night for Labour, the worst perhaps since 1935, so plenty of soul searching from the opposition as well.
Okay, Sebastian, we'll leave it at that. Thanks much for taking the time out and speaking to us as well. So two big news on the global front, and independent emerging markets commentator Jeffrey Dennis joins us right now on the show to talk about this and the implications. Jeff, good having you. Thanks so much for joining us at BloombergQuint.
Thank you.
What's your sense? Risks off the table, and do you think that this will have a slightly materially longer-term impact on how people view risk assets like equities?
Well, I think there's a good chance that's the case. I mean, clearly on the Trump, on the U.S.-China trade deal, we do need to hear more information. On the surface, it sounds like we've got some sort of a deal, and I think what that brings you is the elimination of the next round of tariff increases, which I think is very, very important indeed. And that's been enough to trigger this very big rally in risk assets over the last 24 hours or so. We still don't really know how much of a rollback there's going to be, if any, of the existing tariffs. And I think that's one of the things that bothers me a little bit, that we need to see more medium term on not just no further escalation, but we need to see more of the de-escalation of the trade wars that we've seen so far, So I think we need follow through on that. And of course, as we all know on the program, President Trump often says one thing and does something else pretty soon after. So we need to see this follow through in terms of confirmation on the phase one deal and indeed what progress there could be on the phase two deal. But on the surface, it's very, very good for the world economy. Obviously, on the conservative victory in the apparent conservative victory in the UK election, very good for sterling. So one of the general things happening here, which is helping the risk-on environment, is that the dollar is weaker, and that always helps risky assets, including, of course, EM.
So what do you think this implies for the risk-on trade? Because, the markets, we just showed a chart about how the ASWI World Index is essentially eclipsed its January 2018 highs. So markets haven't quite not priced this in. Do you reckon that it's not fully priced in and therefore there could be more upsides?
I think there probably could be more upside in the short term for sure. I think no doubt about that. But I think what is overhanging all of this still, in my view, is what impact any trade deal, when we still, as I say, don't know to what extent there's going to be a rollback of the existing tariffs. And I think that's a very important point, what impact it has on the global economy going forward, and in particular, what impact it has on the risks of U.S. recession, which in my view remains significant over the next 12 to 18 months. So I think the euphoria is going to take us a bit higher in the short term, but then we need to see whether the trade deal phase one is delivered, and also whether the outlook for the global economy looks a little bit better on the back of that.
Just wondering, Jeff, would you believe that the first bout will rather see the DMs or the developed markets do well, and then the emerging markets turn will come? And more importantly, for the next 6 months or 12 months out, do you reckon emerging markets could actually be the principal gainer of arguably a bit of a risk-on mood?
I think there's no doubt that if we have a risk-on move, and the global economy looks okay from here and starts to improve at the margin, and the dollar continues to weaken, which, as you know, I've always argued is critical for the emerging market performance, I think you'll see EM outperform DM in 2020. I wouldn't be so cute as to say, short-term DM continues to do better until we have more details of this, and then EM does better into 2020. That's trying to be a little too clever, I think. I think what I would say is if this spells the peak or the worst of the trade war, and we gradually get some de-escalation, which has to include tariff reductions, just not the agreement to forestall new tariffs. But if that's what we get, and we also get, therefore, an improving economy, we eliminate the risk of U.S. recession short term, and we get a weaker dollar, then I think EM would outperform DM in 2020 without any doubt. But, there's still some risks out there, and frankly, we need more details on this phase one trade deal. That's the first requirement.
It is the first and a principal requirement. Well, Jeff, your point is very well taken. Thank you so much for speaking to us today on BloombergQuint.
Thank you.
Well, that's an important global voice. Somebody who's tracked both EM sitting out of the US very, very closely for all his years. And he believes that an EM rally would be subject to a few other things, but we need details on this trade deal. However, thus far, the markets are rejoicing the fact that there is a deal in the first place, which is great news. Okay, so from good news to not so encouraging news, and not such encouraging macroeconomic data in India. Retail inflation continued to rise in November, surging to 5.54%, while industrial output continued to contract. Now you know, while the RBI may have paused, even though the contraction in our industrial output happened at a slower pace. Pallavi Nahata has more in this report.
Retail inflation surged to the highest in over 3 years in November because of a steep rise in the prices of vegetables such as onions and also pulses. This was according to data put out on Thursday by the Statistics Ministry. Data for industrial production was also released simultaneously, and that showed a contraction for the second straight month, with most segments registering a decline. Retail inflation jumped to 5.5% in November compared to a 4.6% increase in October. This was even higher than the estimate of 5.3% put out by the Bloomberg poll of 36 economists. The CPI food index surged 10% compared to 7.9% in the same period, largely because of vegetable prices, which increased by 36% on an annual basis. Core inflation also rose, but very modestly, from 3.4 to 3.5%, as consumer demand continued to remain tepid. At current levels, inflation has stayed above the midpoint of India's 4 plus or minus 2% target for the second straight month. Even ahead of the release of the November inflation figures, India's Monetary Policy Committee had flagged off the likely rise in inflation and decided to keep policy rates unchanged. So while inflation continued to climb up, industrial production contracted by 3.8% in October. But this was actually better than the previous month's contraction of 4.3% and was also better than estimated. 32 economists polled by Bloomberg had forecast IIP to contract by 5% in October. 18 out of 23 manufacturing industry groups saw a contraction in output. Within these, the manufacture of motor vehicles, computer, electronic and optical products saw a contraction in excess of 25%. While primary goods, capital goods and consumer durables fell to the lowest in the current series, intermediate goods continued to show a divergence and grew by 22.2%, which was the highest in the series. Whether this is an indication of a turnaround remains to be seen.
Well, and maybe, as I said in the lead into this, is that maybe that's the reason why the Reserve Bank of India may have paused in the meeting gone by. Anyways, moving on to full tilt to markets, and the super rich tax announced in this year's budget may have triggered redemptions from some alternate investment funds. Category 3 AIFs, or Cat 3 AIFs as you would have heard about them so often, are structured as trusts, and the new tax has made these funds less lucrative. Sajid Magat is standing by to tell us about the latest SEBI data. And Sajid, I would have thought that maybe there could have been redemptions due to market issues as well, but clearly the tax issues are at the forefront.
You know, when the proposal was made in the budget about taxing trusts and association of persons, one of the key things which came up was that, you know, domestic alternative AIF industry also works under trust, apart from the noise that came in from the FPIs, because they also come via trust, and the finance minister did withdraw that for the FPIs but retained it for the domestic investors. And one of the concerns was that the domestic AIF industry would be hit, especially the long short funds which are trading through the AIF route. Now the data confirms that part of it, because what we have seen in the month of July to September, for the first time since 2012, that's almost 7 years, we have seen the first quarter of contraction happening, not only in the kind of commitments that have been given to the AIF Cat 3 funds, but also the funds raised and the investments which have been made. Now, there are a couple of things which are there. Before that, let me take you through the numbers which we are seeing. As per SEBI's data which has been released, we had commitments of nearly 47,000 crores.
Commitments meaning?
Commitment means I'm willing to put this much amount of money in your fund.
Okay. So individuals
say that
release that.
Okay. So, when AIFs are formed, individuals have to commit. Okay. Based on that, the fund closure happens, and then you commit, then you raise the fund, and then you invest fund. The three processes which are there.
Three
stages in any AIF which is there. So the commitments were to the tune of 47,000 crores at the end of June. Now those commitments have drastically fallen to 42,000 crores. Now that could only happen when people start withdrawing from these funds. We didn't see in AF1 or CAT1 or CAT2 funds. We saw only in CAT3 funds.
Okay.
And so that set the entire thing rolling, why CAT3 funds are facing that issue. Then we went on to look at how much of funds been raised, which it was around 39,500 crores or something at the end of June. That came down to 37,000. So there has been a withdrawal of the funds which have been raised as well by the investors. And then we looked at what have been invested so far. There has been redemption at that front because it stood at 33,000 at the end of June. Now it's around 31,000, 30,960 odd, which is there. So there has been redemption or of funds which has happened, because of which we see 2,000-3,000 crores have gone out. But that could also be because some of the funds may have closed and they have not been able to roll over or create a new fund, and people are not interested in similar kind of funds.
Okay.
So the three reasons that came out from the entire thing was, one, the trust structure led to a higher tax incident on these funds, especially long short funds, which pay taxes at the rate of 42.7% for there, because they are constantly trading and they have high exposure to derivatives. So that led to reducing of returns, which is happening. Aside of that, you have the fact that you have commissions and LTCGs and short-term capital gains, which basically means that 50% of your returns are basically getting taxed, or there is a cost element attached to it, and as a result of which returns have steeply fallen for these kind of funds there. The second one which is there is a issue of small cap and mid cap in this thing. AF CAT3 was some of the vehicles through which small cap and mid cap investments were being taken. What we have seen in the last 18 months is that the small cap and mid cap hasn't been performing well, and in many cases these stocks have fallen by 30-40%. And so and I'm told that though this data is not available for each of the funds active on the SEBI website, but when you speak to distributors and when you speak to fund managers, they say that many of these funds have negative returns for the last couple of months, and people are not willing to put additional money there. So that was happening. So except for the long short fund, other funds are normally close-ended in some sense.
Sure.
So there is not much of redemption that may happen from there. It could be that the fresh commitment may not go in, but in the case of long short fund, you can redeem and you can exit as well.
Got it.
So there is a massive redemption which is happening from these kind of funds, long short funds, which according to industry experts is to the tune of nearly 8,000 to 10,000 crores in assets. That means that 1/3 of the total invested amount in CAT3 is long short fund which is there.
Okay.
So it's 1/3 of funds which are getting impacted, and that's why it is going there. So the return could, now this money which may be there must be flowing into either CAT2, CAT1 or CAT2, or for that matter in PMS, because PMS also now has a 50 lakh threshold, so they may go into PMS with a focused approach or strategies which are there, but not in long short fund which is happening.
Well, interesting data, and clearly, I know the reason if CAT1 and CAT2 haven't seen these redemptions or these lower numbers, but CAT3 has. You can put two and two together. Sajid, thanks so much for putting that into perspective. Interesting data analysis, and almost everything related to AIFs or PMS services and the performances on our website, done almost every month, so you can try and log in and read more about this as well. As also something that I expect will come up in a couple of days, but let me give you a sneak preview of one such story. Tata Global Beverages is a stock that has rallied 47% this year to hover near record high levels. Remember, the company now houses all of the consumer-facing food and beverage businesses of the Tata Group after the restructuring done in May. Agam Vakil is standing by to tell us what else has changed for the company. Agam, yesterday the whole Tata Group stocks, save for TCS, were very active.
Yeah.
But Tata Global has been on a league of its own of late.
Yeah, Neeraj, a couple of weeks ago you spoke about Trend.
Yes.
And now it's Tata Global. And there are a lot of the relatively smaller companies companies which are starting to, count and make sure that they are counted in the Tata Group in terms of the growth. And this was also a surprise for me, because when I saw the returns of 47% gains on a year-to-date basis, and this is against the FMCG sector gaining only 1% on a year-to-date basis, and of course the Nifty advancing by around 11%. It's a case of clear outperformance. So that led me to go ahead and see the reasons why we are looking at this rally in Tata Global Beverages. Naturally, growth will be right at the top of the list. So if you actually consider the way growth has been through FY18 and FY19, and from there onwards, what analysts polled by Bloomberg are suggesting in terms of growth, you see that from no growth at all in FY18, analysts are expecting 12.5% in FY20 and 12% year-on-year growth in FY21, straight into double digits, and some very prominent numbers here too. But let's not stop just at growth. Let's also talk about profitability, because this is where things are becoming a little more interesting too. So, the yellow line, of course, shows your EBITDA margins number, and it's managed to sustain in over 10% mark, but again we are expecting it to move higher, around 12.5% to 13% in FY20 and FY21. This is of course once again based on Bloomberg polled analysts. And well, as you can see, a very clear improvement in your earnings per share as well is what is expected. So growth coming in place as well as profitability. The question is that what is it that's driving these factors in? So right at the top, of course, we know that just a couple of years ago, and in fact the last 2 years has been about restructuring. So the Tata Group has exited their non-profitable businesses in South Africa as well as China. They've restructured their Russian businesses, and it's taken all the focus away, and now it's only going to be in India and UK in terms of its top brands. Coming down to focus on top brands, 90% of their revenues come from these brands, and more importantly perhaps, the company is now going to focus on its core business of tea, coffee, and packaged water. It's something that has been driving growth, and there was a loss of focus in about 5 years ago, and that is coming back to its core business. That said, among the other factors too, let's not forget that Tata's chemicals, salt business, and some of the other consumer facing products have also become a part of Tata Global Beverages. The salt business itself has an addressable market of around 77,000 crores. This, of course, also aids Tata Global Beverages in terms of, the salt. Of course, it's a very crowded market when it comes to packaged salt. But that said, it's certainly something that will come in aid of Tata Global Beverages. And of course, we have to talk about Starbucks, because this is one thing. Again, a couple of years ago, there was all sort of conjecture whether or not their joint venture with Starbucks will turn up or no. But the fact that they have been able to substantially scale, and the fact that they're looking to expand very aggressively as far as Starbucks is concerned, is also something that will aid bottom line for Tata Global Beverages. So these are the many factors behind which we have seen this gains in Tata Global Beverages. Of course, this is your breakup overall in terms of what we can expect in FY21 with respect to how things can pan out. So of course, a large part of it will be tea if you consider India and overseas, followed by Tata Coffee, which is a very, very important subsidiary for Tata Global Beverages, and salt, which now becomes a part of TGBL as well. That said, let's talk about what the street actually thinks about Tata Global and where it stands with respect to, what its valuations are. So naturally, it's trading near life high, so it is going to be trading at a little bit of a premium to its 5-year average. But look at that, there's not a significant gap between its FY20 estimated 37 times as against its 5-year average of 33 times. Sure, it's had a problem with profitability over the last 5 years, which is why its average PE may be higher. But that said, there very well may be a case, because a lot of other companies trending at life highs are trending at twice their 5-year average. Finally, coming down to your analyst ratings. Again, we have 8 buy calls and 2 sell calls. Return potential may be a problem currently because it indicates a 2% decline there, but which means it's fully priced in all the positives and negatives for that matter. 12-month target of around 312. But analysts remain positive, constructive, and should we see more progress, you very well may expect a little more up move for the stock.
If anything, people would argue that their 5-year average multiples are only 32 or 33 because they've had some issues. If indeed they sort out some of these,
absolutely,
then the right valuation could be higher. Consumer businesses are really skyrocketing.
Absolutely agree with you because, Neeraj, because a lot of the other FMCG companies easily trade above 40, 45 times. So, I mean, there is no reason why Tata Global could not, should it get its act in place, and of course, its expansion plans also fall in line.
Yeah, let's wait and watch. But certainly a stock with a high dose of caffeine, as our line stated.
Yeah.
Great. Agam, thanks so much for putting this into perspective. Very interesting piece on a stock that is doing so well off late. That's all that we have on First Word today. Lots more lined up on Indian Open, though. We get in Jinesh Gopani of Axis Mutual Fund to talk about how is it that their funds have done so well and what is it that the strategy is with regards to investing for 2020. We have a conversation with Vibha Patalkar of HDFC Life on business outlook and tech play at 9:30. But after this break, a full tilt towards the day's trade.